Whole life insurance loans might be the most misunderstood financial tool in retirement and the most dangerous one if you don't know exactly how they work. We're not talking about a minor footnote in your policy. We're talking about a mechanism that can quietly hollow out your legacy over 10 to 20 years if you're not paying attention. So here's the setup. You spent decades building up cash value inside a whole life policy, feeling like a financial genius every time your statement arrived. Then retirement hits, and your advisor smiles and says, "Don't worry, just borrow against the policy, it's tax-free," and suddenly you feel like you've cracked the code nobody else knows about. But here's what that advisor may have glossed over: the insurance company is charging you interest on that loan, typically somewhere between 5 and 8% annually, depending on whether your policy uses a fixed or variable loan rate. That interest doesn't get billed to you like a credit card statement. It accrues silently, invisibly, compounding against you every single year you carry the balance. Let's make this real with an example so the numbers actually land. Say you have a whole life policy with a cash value of $300,000 and a death benefit of $500,000. And at age 65, you borrow $100,000 against it. Your policy charges a loan interest rate of 6%. So in year one, you owe $6,000 in interest on that loan. If you don't pay that interest, and most retirees don't, because the whole pitch was you don't have to repay it, that $6,000 gets added to your loan balance. So now you owe $106,000. By year two, you're paying 6% on $106,000, which is $6,360 in new interest, bringing your total loan to $112,360. You haven't touched another dime of the policy, but the debt is growing like a weed in a garden you forgot to tend. Fast forward 10 years, at that same 6% compounding rate, and your original $100,000 loan has ballooned to approximately $179,000, almost doubling through interest alone. Your cash value has been growing too, yes, but the net available value is being eaten alive by that loan balance sitting on top of it. Now, here's the part that genuinely surprises people. The insurance company doesn't actually take money out of your cash value when you borrow. Instead, they put a lien on it, essentially using your cash value as collateral. But if your loan balance plus accrued interest ever approaches or exceeds your total cash value, the policy lapses, and that's when the IRS shows up to the party uninvited with a tax bill on every dollar of gain you ever accumulated. Let's continue the 20-year scenario because it gets even more sobering. By year 20, that same $100,000 loan at 6% compounded annually has grown to approximately $320,000, which at that point likely exceeds your remaining cash value entirely. When a whole life policy lapses with an outstanding loan, the death benefit your family was counting on goes to zero, and any gain above your cost basis, meaning all those premiums you paid over the years, becomes ordinary taxable income in the year of lapse. So not only does your family not get the $500,000, but you or your estate could face a tax bill of $30,000, $40,000, or $50,000 or more, depending on your bracket. The lesson history keeps teaching us is that borrowed money that feels free, it never actually is. Every financial instrument has a hidden clock ticking inside it. The disciplined move isn't to avoid policy loans altogether, but to treat them with the same respect you'd give any compounding debt, ideally paying at least the annual interest each year to stop the snowball before it becomes an avalanche. If you're going to use this strategy, position size matters enormously. Borrowing 20 or 30% of your cash value is a very different risk profile than borrowing 80 or 90%. Process and patience beat conviction every time. Build a simple spreadsheet. Model out the loan balance at year 5, 10, 15, and 20. And make sure the math still works even if your policy's dividend performance disappoints. At the end of the day, whole life loans are a legitimate and powerful tool when used with eyes wide open, a clear repayment intention, and a realistic projection of where that compounding interest takes you over decades. The irony is that the very feature designed to give you flexibility in retirement tax-free access to your cash value can become the thing that dismantles the legacy you spent a lifetime building if discipline goes out the window. Comfort with any outcome here means being genuinely okay if the best decision is to repay the loan, surrender the policy, or restructure your retirement income plan entirely, because no financial product is sacred, and no strategy should survive contact with reality unchanged. The goal was never to love the tool. The goal was always to fund your life and protect the people you care about. And if you're navigating these decisions and wondering where real estate investing, home contracting projects, or finding the right lenders fits into your bigger financial picture, check out our links in the description below. We're here to help you get started.